Hi, everyone, this is the Encyclopedia Channel. We know that everyone wants to be rich, have a lot of wealth, and live the life they want. In fact, this is not impossible. Everyone has the opportunity to become rich. However, before that, we need to understand the basic logic and laws of how things work, such as what is the difference in thinking between the poor and the rich? Why do rich people think investing is the only way to become rich? What is investment, and how can we improve our ability to invest? The rich are people who have a lot of wealth and assets, usually the economic elite and wealth class in society. The wealth of the rich may come from many ways, such as entrepreneurship, investment, inheritance, etc. At the same time, the rich have higher economic ability and social status, and usually have a high degree of social influence and voice. On the other hand, the living standard of the rich is usually higher than that of the average person, and they can enjoy higher-level housing, transportation, education, medical care, leisure, and entertainment services. Rich people also have more opportunities to travel, participate in social activities and cultural activities, etc., and enjoy high-quality life and cultural experience. In addition, there are many challenges and risks in the life of the rich. They need to face more complex taxation and legal issues, and have higher requirements for personal and corporate financial management and risk control. Rich people also need to assume more social responsibilities and obligations, make contributions to society, and give back to society. Becoming rich is not easy, but it is not impossible. To be rich requires the right mindset, smart decisions, and constant effort and learning. We also need to understand the difference in thinking between the poor and the rich so that we can move towards the rich. The difference in thinking between the poor and the rich is a widely discussed topic, involving individual attitudes, beliefs, habits, and behaviors. Below we will analyze the difference in thinking between the poor and the rich from several different angles. First, the attitude towards money. Poor people often view money as a scarce resource, and they pay more attention to protecting the limited resources in their hands, such as income and savings. The rich value investment more, and they are more willing to use their money to create more wealth and value. They believe that through continuous innovation and investment, more returns and opportunities can be obtained. Poor people are often unable to own more capital because of excessive frugality, while rich people use capital to create more opportunities and wealth. For example, the poor may deposit most of their income in the bank, or choose some low-risk financial products. The wealthy are more inclined to invest in high-return projects such as stocks and real estate, or to start businesses and invest in their own companies. For example, Chinese entrepreneur Ma Huateng, whose Tencent company has huge influence and market share in the internet industry, has brought huge wealth and value. Second, the attitude towards failure. Poor people are usually frustrated and discouraged by failure, and they often fail to learn useful experiences and lessons from failure. The rich value failure more, and they believe that through continuous trial and failure, they can gain more opportunities and experience, and finally succeed. They learn from their failures, take lessons learned, and do better at the next opportunity. For example, the famous entrepreneur Elon Musk has created many companies, many of which have failed. But he summed up experience and lessons from every failure, constantly improved his ideas and innovations, and finally successfully created Tesla, SpaceX, and other leading technology companies, becoming a world-class entrepreneur. The third is the attitude towards opportunities. The poor often give up opportunities because of their scarcity and their own inadequacies. The rich are more keen to seize opportunities and are good at tapping the potential of markets and industries. They believe that through their own efforts and innovation, more opportunities and wealth can be created. They typically act aggressively, constantly looking for new opportunities and market spaces. For example, Ran Jingfei, the founder of Huawei, is an entrepreneur with a strong sense of opportunity. In 1997, the Chinese government decided to promote the reform and opening up of the domestic communication market. Ren Zhengfei saw this opportunity and led Huawei to successfully enter the communication market, continuously innovating and expanding its business scope, and eventually became a world-renowned communication equipment supplier. Fourth, the understanding of one's own ability. Poor people often have little confidence in their own abilities and skills, and believe that their abilities and talents are immutable. The rich, on the other hand, pay more attention to their own abilities and skills, and believe that through continuous learning and hard work, they can improve their abilities and skills, thereby gaining more opportunities and success. For example, the famous investor Warren Buffett has always believed that his investment ability can be improved through learning and practice. He continues to learn investment knowledge and market information, while actively looking for and analyzing investment opportunities. Through years of practice and continuous improvement, he finally became a world-renowned investment master. See, the difference in thinking between the poor and the rich is stark. Poor people usually pay more attention to protecting existing resources, while rich people pay more attention to creating and investing resources. Poor people usually pass up opportunities because of failure and scarcity of opportunities, while rich people are more keen to seize opportunities. Poor people usually believe that their abilities and talents are immutable, while rich people believe that through continuous learning and practice, they can improve their abilities and skills. These differences in thinking largely determine a person's success and wealth. At the same time, through the analysis of data, we found that the reason why the rich become rich is that they invest. This behavior doubles the original capital and quickly accumulates huge wealth. So, why do you say investing is the only way to become rich? Below, we'll dive into this topic and use examples to illustrate the importance of investing for wealth. Investment can realize wealth appreciation, and investment can allow people to use idle funds to obtain higher returns. In the past few decades, the stock market, bond market, real estate market, etc. have all shown very strong growth momentum. By investing in these markets, one can enjoy lucrative returns from market growth. Taking stock investment as an example, the stock market has shown a strong growth trend over the past few decades. According to data, the annualized rate of return of the S&P 500 index in the United States has reached 9.8% since 1950, while the inflation rate during the same period was only 3.7%. This means that if a person invested $1 in 1950 and held it until now, the value of his investment would have grown to $158. Likewise, if he uses this investment for consumption or other purposes, his purchasing power will be eroded by inflation. Investing can lead to financial independence, which is when a person does not need to depend on income from work to maintain their standard of living. Investing can help people achieve financial independence because the income from investments can provide people with an additional source of income. If a person's investment income is sufficient to meet his daily expenses and living needs, then he can achieve financial independence and no longer have to rely on job income. The famous investor Robert Cialdini emphasized the importance of financial independence in his book Rich Dad, Poor Dad. He believes that the income earned through investments can provide people with an additional source of income and thus financial independence. Cialdini himself is a successful investor. Through continuous learning and practice, he has successfully achieved financial independence and created great wealth for his family and business. Plus, investing can help people deal with inflation, which is a general rise in prices that reduces the purchasing power of money. Inflation is a double whammy for investors because it not only reduces the real value of investments, it also reduces the purchasing power of investors. However, investing can also help people cope with the effects of inflation. If a person invests money in stocks, bonds, real estate, etc., he can get a higher rate of return, thereby offsetting the impact of inflation. This is why many investors choose to buy inflation-protected assets, such as gold and commodities. Finally, investing can help people achieve long-term financial goals, such as buying a home, retiring, and more. By investing, people can earn a higher rate of return and use the funds to achieve their long-term financial goals. If a person wants to buy a house in the next few decades, then he can consider investing part of his funds in the real estate market. This way, he can enjoy the benefits of a growing real estate market while still saving money for his long-term financial goals. Similarly, if a person wants to achieve the goal of early retirement, he can invest part of the funds in stocks, bonds, and other markets to obtain higher yields and achieve the goal of early retirement. By investing, people can achieve higher yields, achieve financial independence and long-term financial goals, while also managing the effects of inflation. Of course, investment also has risks, and investors need to understand the risks and take corresponding measures to avoid risks. Considering that some friends have a vague concept of investment, here is a brief explanation of the meaning of investment. Investing refers to the act of putting money or resources into projects or assets with potential returns in anticipation of future gains or profits. The purpose of investment is to increase wealth or assets, and it can also create more value and opportunities for individuals or businesses. There are many types of investment, including stocks, bonds, real estate, financial derivatives, private equity, entrepreneurship, commodities, digital currencies, and more. Different types of investments have different characteristics and risks, and investors need to choose according to their own needs and risk tolerance. For example, the stock market, which is one of the most common areas of investment. Stock investors can become shareholders of a company by buying shares in the company and share a portion of the company's profits. The earning potential of the stock market is high, but there are also certain risks. Investors need to understand a company's financial condition and market prospects in order to make informed investment decisions. There is also the real estate market, which is also a long-term investment field. Real estate investors can obtain rental income and capital appreciation by purchasing real estate such as houses, apartments, and commercial properties. The rate of return of real estate investment is relatively high, but it also has certain risks, such as interest rate risk and market risk. Real estate investors need to understand the local real estate market and investment risks in order to make informed investment decisions. At the same time, venture capital is a kind of venture capital. Investors can provide funds to startups and share the shares or profits of the enterprises. The earning potential of venture capital investments is high, but there are also significant risks. Many startups face the risk of failure in the early stages of their business. Therefore, entrepreneurial investors need to understand factors such as the business model, team, market prospects, and risks of a startup company in order to make informed investment decisions. Then there is the digital currency market, which is an emerging investment field, including cryptocurrencies such as Bitcoin and Ethereum. Investors can earn returns on investment by buying and holding digital currencies. The earning potential of digital currencies is high, but they also come with significant risks. Digital currency investors need to understand the operating mechanism and value fluctuations of the digital currency market in order to make informed investment decisions. There are also many principles and methods of investment, including value investment, growth investment, speculative investment, long-term investment, and so on. Investors need to adopt corresponding investment strategies and risk control measures according to the actual situation of the investment object and the market environment. Although, investing is a very important financial management method that can help people achieve financial freedom and wealth growth. However, there are risks and opportunities as well as uncertainties in every investment field. Investors need to fully investigate and understand different investment fields, and need to have a clear understanding and grasp of the risk tolerance of the market, industry, and individuals, and at the same time need to take corresponding risk control measures, such as diversification of investment, stop loss, etc. Investment is an important economic behavior that can bring great value and opportunities to individuals, enterprises, and society, but it also requires investors to have certain professional knowledge and capabilities, and to continuously learn and improve investment skills in practice. So, how to improve investment ability? The following will explain how to improve investment ability from 4 aspects: investment thinking, market analysis, risk control, and psychological quality. First, improve investment thinking. Investment thinking refers to applying various knowledge, skills, and experience in investment, rationally analyzing the market, looking for investment opportunities, and making correct decisions. The improvement of investment thinking needs to be realized through continuous learning and practice. Investors can improve their investment thinking by reading investment books, participating in investment training, and learning market analysis methods and technical analysis. Second, conduct market analysis. Market analysis refers to the analysis of market trends, quotations, trends, etc. in order to understand market changes and trends. Market analysis can help investors predict market trends and formulate correct investment strategies. Investors need to understand the impact of economic, political, social, and other factors on the market, and at the same time master fundamental and technical analysis methods to analyze market dynamics more accurately. Second, carry out risk control. There are risks in the investment market, and investors need to carry out risk control in investment to protect their investment to the maximum extent. Investors can reduce risks by diversifying investments, setting stop losses, and avoiding blindly following the trend. At the same time, we must pay attention to the balance between investment returns and risks, and do not be greedy and blindly pursue high returns to avoid losses. Finally, pay attention to the improvement of psychological quality. Psychological quality refers to an investor's ability to remain calm, rational, and self-disciplined in the face of investment risks and market fluctuations. There are factors such as temptation, greed, and fear in the investment market, which can easily cause investors to lose control of their emotions and make wrong decisions. Investors need to improve their psychological quality to deal with market fluctuations and risks, keep calm and rational, and avoid emotions affecting investment decisions. Therefore, improving investment ability requires continuous learning, practice, and improvement, focusing on investment thinking, market analysis, risk control, and the improvement of psychological quality. Investors need to maintain continuous investment enthusiasm and sensitivity to the market, and we need to understand market dynamics, master investment skills and strategies. In addition, practice is also an important means to improve investment ability. Various methods can be used to practice investment skills and strategies, reduce risks, and increase success rate. Of course, mistakes will inevitably be made in practice, but only by learning from mistakes and constantly improving and enhancing one's investment ability can one move towards success. In addition, establishing a good investment mentality and attitude is also an important aspect of improving investment capabilities. During the investment process, it is necessary to have a calm, objective, rational, and firm mentality and attitude, free from external interference, and avoid investment misunderstandings such as blindly following the trend, greedy and impulsive. At the same time, we must maintain a prudent, stable, and long-term investment concept, pay attention to factors such as risk control, asset allocation, and long-term returns, and pursue long-term and stable investment returns. To sum up, only by continuously improving one's own investment capabilities can one better grasp opportunities and achieve wealth growth and financial freedom. That's all for this episode of the program. Do you have any views on investment? Welcome to leave a message in the comment area to discuss with everyone.